We've just held Argo Investment's 2025 annual general meeting, and I'm joined now by our Managing Director, Jason Beddow, who's going to discuss his view of the market, the company more broadly, and his outlook. Jason, I wanted to start by asking you first to reflect on Argo's discount to its net tangible assets.
Look, it's a great question and very topical for the sector, I think, generally. We've still got 80 odd LICs in the market, and I think all pretty much trading at a discount. Look, I think it's a combination of many things. There was a lot of exuberance for LICs through COVID when there was zero interest rates. We've seen a lot of that reverse. So a lot of people are selling out with higher interest rates. ETFs are, they're a fairly strong competitor as a product. And a lot of advisors, I think, are pushing ETFs because it's quite easy. And also hot markets. I mean, we always think and continue to think that the discount is a cyclical thing and that it will revert over time. And if we look at a longer time chart, Argo's moved through discounts and premiums quite a lot over the last 30 years. And, I'm not saying it is quite the same, but history doesn't repeat, but it rhymes, is the last time we were at this big a discount for so long was just leading into the first, technology boom. So 98, 99, we were a big 15% discount for a couple of years, and, we now have that ended. And in 2001, Argo was a 10% premium. Likely we'll get some more cutting of interest rates. And so we think, we're still confident that, the discount will close over time.
And is Argo taking any steps to narrow the discount?
Certainly. I mean, I guess marketing and communication with our shareholders and prospective new shareholders, continue to focus on growing and maintaining a fully franked yield, which is not new. But I think as we continue to grow our yield and the franking, the index where it is now, the market pricing, the index yield is falling. It's low, 3.2%. It's only partially franked. We're likely to get potentially another rate cut next month. So the cash rate's into the 3.3, 3.4. So our yield is circa 4% cash and 5.7 when you count franking credits. And just with our capital management, we've been neutralising DRPs. So that means we're buying the shares on market, not issuing at a discount. From time to time, we'll buy some shares as well. And we think that's prudent. It's accretive. It might not close the discount, but it's accretive to those remaining shares as far as EPS and potential dividend growth into the future. So, we're not aggressively chasing any strategy, but, subtly we're just continuing to sort of do those things. And we think with different market conditions, we do genuinely think if the market was to fall and fall significantly, the discount could close significantly in a pretty short period of time. Not, saying that will happen.
And turning now to the market, since the election of Donald Trump almost a year ago, it's been a pretty wild ride for investors. And there's been a range of geopolitical and macroeconomic risks, some of them still persisting, various policy pronouncements and announcements from Donald Trump, leading to quite a lot of volatility. But markets are at record highs today. What's sustaining markets at these levels? First, maybe if you could speak to the US and then Australia.
Yeah, sure. Look, it's tricky. There's clearly a lot of cash looking to invest. The US Federal Reserve is cutting interest rates. And while that alone is not a reason, it's generally supportive of equity markets. It takes money from cash, which are at record levels, trillions of dollars, and they go looking for other, alternatives to get a return. And equities is clearly one of those. There's a huge amount of investment in AI and technology stocks, generally speaking. I mean, the US has been a dominant part of global markets for decades. But, we've gone from maybe 50 or half of the world's stock markets to 70%. And, the bigger companies in the US, like NVIDIA, are the size of Germany. And it seems to be, they just invest. Whether the returns will come from these investments over time, we don't know. But, the likes of the Microsofts, Amazon, all of these stocks are aggressively having to invest. Everyone wants to be the winner in AI, and that includes China and other countries as well. So it's a bit of a race, and investors are getting caught up in the frenzy of it. And I guess that's why markets look expensive, because a lot of these investment and share price movements, there's not a lot of earnings behind it.
So with valuations looking quite stretched, are we headed for another dot-com-like boom? Bust?
I wish I was that good, Meredith, and had a crystal ball. But look, I think the higher markets get and the more stretched valuations get, the greater the risk if something happens that markets fall harder. And, you'd argue there's a reasonable air pocket now of where you might get valuation support for a decent amount of the market. So, we're aware, but equally, and we were highlighting this recently in the AGM, that, markets, the last blow off in the first tech boom of 99, 2000, it doubled again in the last 5 months. So, I guess as a professional investor, and we're an equity investor for our shareholders, we want to stay for most of the ride. We want to be largely invested for the upside, but we are definitely cognizant that, from this point on, and particularly with the uncertainty of President Trump, and we've had more noise and I think news and volatility in the last 9 months since he was inaugurated, and it feels like 9 years. Cognizant that something could happen tomorrow. And I think we'll be with that volatility for while he's the president.
And with Australian markets, what's sustaining them at these record high levels?
Yeah, again, I look at a combination of things. I think when we went back to start of the year, there was a lot of concern that the US was really going to punish China. A lot of investors who invest in Asia Pac, which includes Australia, so the Asian Pacific region, were taking money out of China, and Australia is part of those indices where they invest. Following that, we also had, there's some skepticism about the strength of the US dollar, how the US economy will recover, well, not recover, but how it will look in 12 or 18 months' time. And maybe people are taking a little bit of money out of the US, but want to be in developed markets. Again, Australia is a reasonable home. We still have very supportive superannuation flows in Australia, and we have very little equity issuance. We've got a number of buybacks. There's been some IPOs, but they're quite small. So I think we've got an increasing amount of cash or assets looking for a home. And I think Australia is perceived to be a fairly defensive market, where it's well geared, pretty politically stable at least. So no huge surprises. So I think people are happier to maybe overpay, arguably, but for the security, they're not going to be massively negative surprises.
So in the current environment, where and how are you positioning Argo's portfolio? Where are you seeing value?
Look, it's always fairly modest with Argo when we're trimming positions or buying. We still think resources generally look more attractive than banks. I mean, the banks have had a huge run. We think they're okay. They're about to report results. They'll be pretty benign. The credit cycle is very, very benign in Australia. But these are some of the most expensive banks in the world now. With fairly modest growth. We think commodity demand will be strong with data centres, the electricity demand. Renewable rollout is still very strong as well. We've got defence budgets going up around the world, all fairly commodity intensive. And we think the supply is going to struggle to meet it. So that should be constructive for commodity prices. The big miners here have good balance sheets. They're well managed. So we think that's a reasonable place to park some money. And I guess some of the sort of forgotten industrials, there's the haves and the have-nots. There's some stocks that just trade on excessive multiples, we believe, and others that are relatively cheap for the cash flows. And we're probably more interested in those stocks at this point of the cycle than chasing some of those high growth names.
One of the companies you've added to the portfolio is Firmus Technologies. It's leveraged to this AI boom. Can you provide the investment case for this company?
Yeah, sure. Look, it's a pre-IPO, so this stock should hopefully list 2026. It has a liquid cooling system that lets data centers run cooler, which means they need less electricity, and that's the biggest cost of a data center. It's a massive demand. So they have their cooling system is in a Singaporean data center now, which is a very hot, humid climate, and if it's working there, that's a great, endorsement of the technology. They've just announced a deal with the data center division of Infratil, which has a number of data centers. And that gives us confidence because Infratil know how to build, manage and run data centers. So Firmus is not going to build data centers. They're just going to put their liquid cooling into the data centers. And they also have a relationship with NVIDIA. So these data centers will become AI factories more so than data centers. And, based on the economics of now, they look like they've got pretty attractive returns. Look, it's a fairly modest investment for us, but we are conservative. We do want to play some of the high growth thematics, and we think this one looks pretty attractive risk reward.
And still on AI, but a slightly adjacent topic. How is your investment team using these technologies? Are you harnessing AI in any way?
Well, harnessing is probably a little strong. We're certainly using it. Look, funds management, banking, finance it's a data-rich environment. So using AI to sort data, filter, look for, I guess, things coming out of obscure medical journals in Europe, perhaps. AI can find this for you really easily, very concisely. So it's certainly allowing people to do more in less time. And maybe over time, it means you'll have less people. I guess what it doesn't do, though, is it's great at giving you a summary, but unless you want to sit down and read the document, everyone's getting the same one-page summary. I guess how you interpret that. And if it was a perfectly uniform market based on AI, every stock price would be perfect. And clearly that's not the case. So we're learning, we use it actively and doing more and more with it. And I think we will continue. We're including it in our process. But I guess it's not yet at the point where it's making decisions. And we've run scenarios on deep research, very complicated, and to be fair, above my head, there's some young, smart people in the team using it. Ask him to recommend stocks, and in the same breath, it will recommend a stock and then not recommend a stock. So we think that you're still going to need that human interaction, talking to management teams, site visits. Who the shareholders are. Does someone lose a mandate? Is there a line of stock coming? There's still a lot of moving parts. I think that if you're engaged with the market, that you will still have an edge.
Still got a job for now.
Still got a job for now.
China, Australia's biggest trading partner, posted some fairly lackluster economic data recently, and obviously there's still the simmering trade tensions with the US. What is your outlook for the Chinese economy, and how does that relate then to the Australian market and specifically our miners?
Yeah, look, it's a good question. I mean, China's really not recovered from COVID. I think they were locked down for a long time, very militant, changed a lot of rules. So, their population is not traveling as much. There's less investment into China. People are much more skeptical on China. Having said that, their exports to the rest of the world are growing. So they're not growing to the US perhaps, but they're so efficient in manufacturing and new manufacturing. Look at their electric vehicle fleet, batteries, that the rest of the world are buying from China. So we think we're okay from the commodity demand perspective for the big miners. The pricing will move around as it always does. But we could argue we're almost at max input of China and US because, there's not a lot going into China now. You can look at the import data and there was a lot of brought forward. I guess a lot of importers stockpiled pre-tariffs. And you look at the data now and exports to the US are well down. China's got a few structural issues. Population growth has turned, so there's a shrinking population. And while that's not dire now, in 10 or 20 years, we're starting to fall off. You're only a couple of generations between having hundreds of millions of less people in the country. So that's a challenge. So, we're always nervous on China a little bit, and this is from a long time ago, I guess we were always happy to invest in companies in things that China needed. China still basically needs resources. It can build processing facilities, brands, a lot of other things, and we think they're really tricky businesses. Still needs our iron ore. Still happy to buy, rare earths and other processing and other metals. And so, we're comfortable, but I guess, China's always a watch.
Turning back to a topic now close to our shareholders' hearts and many other Australian investors, and that's dividends. You talked about Australian dividends, the dividends paid by the market falling, yet Argo's paid a record annual dividend this year. Can you comment on that and also the franking? Sure.
So I guess there's a couple of components to our dividend. So we receive dividends from our investee companies, and the intention is, after expenses and tax, that we distribute that all to shareholders. But as a company ourselves, we pay company tax rates. So when we sell profits and on unfranked income, which could even just be interest, or unfranked dividends, we generate our own franking credits. So over time, as I guess more companies have gone offshore, they're paying a bigger percentage of unfranked dividends or partially franked, your CSLs, your Macquaries, Aristocrat, Brambles, there's a whole raft of these companies. So as they're unfranked, their dividends growing, their franking level is falling. There's a larger proportion of that we are paying tax on, so we're building up franking credits. And then, as I said, when we sell at a profit, so we I guess can maintain a dividend above the market if we're thinking that franking credits are more valuable to shareholders, we certainly want to keep a buffer. We saw in COVID how quickly you can eat into them. But equally, we're still growing our balance, and we think that that would support us growing our dividend over time to shareholders, even though the yield on the market itself has been falling for some time.
Headlines are dominated by AI investment, geopolitical risks, tariffs, other trade issues. What things do you think the market is missing? What's not being factored in?
Look, it's a good question because there's plenty of reasons, and I think April was a great one. The tariffs came out, they were more aggressive than people thought. The market fell, I think, 14-15% in 2 weeks. And then President Trump sort of stepped back from a number of these things. And I guess the rhetoric since then is, well, if the markets react too badly, well, that won't be implemented. So even though there's a lot of noise out of the US, I think the market's still largely treating it as noise. You've got a Federal Reserve that's still got plenty of firepower if it needs to cut rates, if the economy does fall. And the US is far more aggressive on monetary policy than we have tended to be in Australia. So I just don't think there's a lot of risk priced into something going wrong in the world, whether it be private equity blowing up, which I'm not saying it would, and it would be isolated, liquidity, being put under pressure in places. But markets, I think, are generally in favour that, if things are too bad, they'll be reversed. Central banks will support, and governments actually globally are spending, fiscally supporting economies as well. So if things get too bad, governments like to be re-elected. You don't get re-elected in recessions, and you don't get re-elected if unemployment rates are very high. So they're also spending a lot of money in the economy to prop them up. So I guess investors look at all this and go, well, we're less likely to get a big negative shock, and so we want to be invested.
So bullish in the short term and maybe more volatility on news and announcements. What about in the medium to longer term?
Look, the medium longer term's a little tricky. I mean, you've clearly got a bit of a polarised world. The US is losing a little bit of stature as the global watchdog, I guess, at least. Clearly, there's a group of countries that maybe are not all allies, but are equally, not great allies to the US. There could be another currency backed by gold that, potentially China, Russia, Iran, Brazil, India use for trade. I'm not saying that will happen. Trump, we know one thing, it's his second term. So he might get through the midterms, but in 3 years' time, he won't be the president. If the economy's in good shape, maybe Republicans go again and it's more of the same. But if the economy's not in good shape, the Democrats get in and a lot of things are reversed. And they go out with the dove and say to everyone, we're sorry, and let's all get back on board. So it's a little tricky with where things are just now. But, look, over time, markets, because I guess companies in an inflationary environment, if not, money should flow to the more profitable businesses. So we don't think markets are dire, but they have had a great run. And if they were to fall, it might take some years to get back. But so I think you need to be a little nimble.
Thanks very much, Jason. And thanks so much to all our shareholders who joined us at our AGM today. And we'll look forward to seeing many of you again next year when we host our Investor Roadshow.